Hey everybody, it's Dr. Joe here in the house on this Wednesday evening. Hope you're doing well wherever you're tuning in from. And hope you had a good week. And today I thought I'll talk about credit. And, credit obviously is a very, very important topic for real estate investors. But I think it's an important topic for generally for anybody, who intends to do business or get a job or, apply for a loan or whatever. And nowadays, even insurance. Nowadays, a lot of employers do a credit check on you just to see what your, financial astuteness or financial discipline is. And, and so it's really important for us, you and I, to understand how credit works, the importance of it, and how we really need to master our credit scores and so on. It's case in point, I just did a refinance. In fact, it was yesterday, just finished yesterday, and one of my properties. And obviously, they pull a credit check, they pull a credit report, and based on the results of the credit report, it will determine whether I'll get the loan or not. And fortunately, my credit is pretty good, so I didn't have a problem with that. But I know too many people who do not have good credit. They don't understand how the credit systems work and do things that comes back to bite them and haunt them many years or months from now, and they regret it, and it takes a long time to resolve some of those issues. So that's the focus of today: improving your credit score for better financing options. And so that's what we're going to talk about today. So let's get down to it. And so I suppose the question is going to be, how does your credit score impact your ability to grow a profitable real estate portfolio? And as real estate investors, obviously, we buy houses. Many times we renovate houses and fix them up and sell them or rent them out. And, given the Washington, D.C. area where it's very expensive, I'm sure it's expensive where you are. Most people don't have the $300,000, $400,000, $500,000, $600,000, $700,000 hanging around, to buy the house. They have to borrow the money from somewhere, either it be a mortgage company, a bank, a financial institution, friends, family, whatever it is. They need to borrow money because they don't usually have all the funds available at that time. So it's really important, not just for real estate investors, but generally, as I said earlier on. So for real estate investors, the credit score is far, far, far more than just a number. It's the gateway to financing opportunities that can and will drive your success. A strong credit score signals to lenders, to borrowers, to lenders and banks and institutions that you are a quote unquote a low risk borrower. That in turn means that you're opening doors to lower interest rates, higher loan approvals, and more flexible terms on the financing. On the other hand, a poor credit score, a low credit score, can create barriers, and such as costly financing, loan rejection, you get turned down for loans, or missed investment opportunities because you just don't have the money to do a deal, which slows down your ability to scale over time. So real estate investing, especially strategies like the BRRRR strategy, that's the buy, renovate, rent, refinance, and repeat, relies heavily on leverage. Leverage is essentially you're taking your limited money and borrowing a large amount of money. So without access to affordable financing, your cash flow and overall return on investment ROI will be severely impacted. So when you secure loans at lower rates, because you got good credit and so forth, what it does is that, it helps you to borrow cheaper, which in turn will mean that you're more profitable. Okay. So in this live stream today, what we're going to do is explore practical ways where you can improve your credit score and the consequences of ignoring it, the consequences of not even thinking about credit, and how a strong credit score can enhance your ability to grow and scale in the real estate arena. Okay, so whether you're a new investor, seasoned investor, securing your first deal, or you've been doing this for a while, I think mastering credit score is essential for long-term success. So I broke today's session into 5 parts. And so let's get down to number one, which is what makes up your credit score. I talk about credit score. What does it actually mean? How does it, how does it comprise? How does it, how do you get to this score? What's it comprised of? I suppose the question is, what factors influence your credit score, and how can you control them? So what goes into the credit score, and how can you control that? Okay, so your credit score is determined by five key factors, each playing a critical role in shaping your financial profile. Okay, so there's five elements to a credit score, and I'm going to kind of briefly talk about each one now. The most significant factor is your payment history, which accounts about 35% of your total credit score is due to your payment history, which reflects whether you pay on time, pay consistently as agreed, or you don't pay, or you pay slowly. That if you do that, don't pay or pay slowly, it affects your credit score big time. Okay, so late payments, defaults, or delinquencies can significantly lower your score. Okay, so it's really important, if you want to improve your score, you pay on time, you pay as agreed, and don't be late, and don't skip out, and don't default. Otherwise, it's going to take a huge hit on your credit score. The next important thing is what we call credit utilization. And this accounts for about 30% of your score. And what is credit utilization? Well, it measures the percentage of your available credit that you're using. Okay, and so for instance, if you have let's say a $10,000 credit card, okay, and you maxed it out, so you've put $10,000, you bought stuff for $10,000 in your credit card, so you got 100% utilization. Okay, and let's just say you got a $10,000 credit card, and then you only use 1,000. That 1,000 represents 10% utilization. You got it? So it's a percentage of utilization, is how much you're using as a function of the total that's available to you. And they recommend that you try to keep it below 30%. So if you have a $10,000 credit card or credit limit, then you don't want to spend too much more than $3,000. Okay, keep it below 30%. If you can keep it lower, I think even better. 5%, 10%, I think is fine. Okay, and the next thing is, so we've talked about your payment history. We've talked about utilization. The next thing that affects your credit score is what we call the length of your credit history. And length of your credit history, which accounts about 15%, which means that the longer you've had your credit availability, the better it is for you, and so on. So try to keep if you got credit cards or loans or whatever, try and keep it going for a little while, especially credit cards anyway. And rather than just tearing it up and canceling or closing out these accounts, because the history, how long you've had these credit facilities, has an impact on your total credit score. Okay, and it counts for about 15% is your credit history. The next thing is the credit mix, the type of or the variety of credit that's available to you, such as mortgages, credit cards, car loans, student loans, and so forth. So you have a mixture of different types of credit. That accounts for around 10%. So it's good to have a mixture of different types of credit rather than just one. And finally, the other thing, which is 10%, is what we call credit inquiries. So credit inquiries is how many times people pull your credit report, i.e., do what we call a hard inquiry into your credit. How many times do people inquire about your credit? Typically, if you're applying for a loan, applying for a credit card, applying for something, the lender is going to do a credit check, and they're going to pull a credit report, which means that it's what we call a hard inquiry into your account. So the more that you do, it tells people, hey, this guy is looking for loans. He's looking to borrow money. And that sometimes is not a good thing. So you want to limit the number of inquiries that's being affecting your file. And so I suppose the thing is that by understanding these components, investors like you and I can target or can do things to improve our credit scores. Well, obviously, we can pay on time, so reduce the number of late payments or never have any late payments. Credit utilization, we can reduce the utilization on that credit card. We can have keep our loans or credit cards for a long time. We can have a different mix of different types of loans. So things that we can do, you can do to improve your credit score. And the other thing is to, it's not just about avoiding bad habits, but it's about building a financial reputation that inspires trust with lenders. No one's going to borrow you money if you have a history of not paying the money back. That's, would you borrow the money to somebody who's probably not going to pay you back? Probably not. And your credit score tells people your, your history and whether you're reliable and whether they feel like they can trust you to pay the money back, and so on. It's really a major deal, especially in the United States. Anyway, when I was in England, the credit score wasn't such a big deal, but now it is. Okay. So, what are some of the action items that you can do associated with your credit score? Well, you can pay on time, obviously. Set up automatic payments to ensure bills are paid on time. You can monitor your credit utilization. You can keep credit card balances below 30% if you can. And you can also review your credit report on a regular basis and dispute anything that's not true or inaccurate. Okay, so that's number one done, which is what makes up your credit score. Number two is, why does a high credit score save you money? Why should you have a high credit score? What's in it for you by having a high credit score? I suppose the question is, how can improving your credit score reduce borrowing costs and increase profitability? So how can improving your credit score reduce your borrowing costs and increase your profitability? Well, your credit score, as I mentioned before, has a direct impact on your interest rate that you're charged. And if you got good credit, you're less risk, which means that the lenders feel comfortable in borrowing you money at a lower rate. If you have a low credit score, then it means that you kind of have you're riskier. And therefore they're going to say, well, if I'm going to borrow you money and it's a higher risk, I'm going to need a higher interest rate to cover, my my potential losses here. So it does make a difference. So you're going to pay a little bit more. So what does that mean? So for instance, if you borrow $300,000 for a loan for a mortgage, just a 1% difference between, let's say, over a $300,000 loan over 30 years, that 1% difference, because your credit score was higher or lower, can mean that you're going to pay $50,000 more in interest over 30 years. So just because you had bad credit and your interest rate was up by 1%, that could mean that you're going to pay over $50,000 more in interest over that duration of that loan, just because your credit was lower, if you can even get credit in the first place. So access to better financing terms also increases your purchasing power. Because loans are usually done quicker, they're approved quickly, and because they're approved quickly, it means that you can get the money quicker, which means that you can get the deal done faster. Okay? You can take advantage of opportunities. Conversely, if you got a lower credit score, it can force lenders into borrowing you money at a higher interest rate. You may have to go things like hard money or loan sharks or private financing. I'm not saying there's anything wrong with those things, but you're paying a premium versus you can get cheaper money if you had better scores. So improving your credit score isn't just about saving money. It's about positioning yourself for long-term growth, long-term success. So with reduced borrowing costs, because you got high score, you can reinvest those monies that you save into acquiring more properties or doing other things. Okay, so what are some of the action items you can do associated with, trying to get high credit score? You can compare offers. Always shop around for best rates when you're trying to get money. Don't always just go to the first bank or first lender. Shop around, see who's offering the best terms. You can track your savings, and you can calculate potential savings by the fact that you've just now saving more money because your interest rates are lower. Okay, number 3. What happens if you ignore your credit score? If you say, I'm not interested in credit score, it doesn't affect me, it's no big deal. I'm too busy, doing whatever I'm doing. I don't have to worry about credit. No one's worried about that. It's not a big deal. What are you talking about, Dr. Joe? You know, don't worry about it. Well, the question I suppose you're asking is, what are the risks associated with neglecting your credit score as an investor? So why should you care? What's the risk? What's the impact if you don't take your credit score seriously? Well, ignoring your credit score can severely hinder your ability to scale, your ability to buy more properties, your ability to do more deals, and to grow your real estate portfolio. Okay, investors with poor credit are often offered higher interest rate loans. Okay, and higher interest rate means it's more expensive and it's more challenging to get. These higher costs can erode your cash flow, makes it less profitable, and it's just harder to grow a portfolio if your borrowing costs are real high. So in extreme cases, a low credit score can lead to just out and out rejection. They'll just decline your loan request because your credit score is shot, is low, and you're a high risk. So they don't feel like it's worthwhile to borrow you the money because they may not get it back. And that's why I tell people it's really important to take your financial responsibilities very seriously. If you say you're going to pay money back, pay it back. Otherwise, don't take it. You'll spend the money, you blow the money, and now you got to pay it back, and you don't have the means, and therefore it's just a spiral downhill. Poor credit, impacts your ability to refinance properties. To take out money if you're doing, especially the BRRRR strategy, the buy, renovate, rent, refinance, repeat. And investors may also, feel trapped in, a stagnant growth. They can't grow their portfolio. They can't get more loans because no one's prepared to borrow them money at a reasonable rates. So by neglecting your credit score, you not only risk short-term setbacks, but also you limit your long-term financial flexibility. Okay, it's a big impact, both short-term and also long-term, especially if you're trying to seek financial independence and trying to get out of the rat race and do things for yourself and make money passively and things like that. So proactively managing your credit ensures you're always ready to take advantage of new opportunities. And let's go back to the action items associated with this. There's several things that you can do. You can identify weak spots. So you can use your credit report to identify areas that you need improvement. Pull a credit report from on yourself. It'll tell you the good, the bad, the ugly, what you can do, what you should do, what you should be addressing. Create a plan. Outline steps to repair any damage or to your score. There's things that you can do proactively. You can question. You can contest certain things that's in your credit report. And also you can track the progress, monitor your score on a regular basis, and therefore if there's anything happens negatively, you can deal with it straight away. Okay, so kind of number 3 so far. We'll get to number 4, but kind of midway through. So we'll be going to the Q&A sessions in about 10 minutes from now. Again, put your questions in the chat box, and I'll be more than happy to get to them and answer any question that you have about credit, real estate, investing, landlord, tenant, anything to do with real estate, investing. Put them a question in the chat box, and I'll get to them in about 10 minutes. Also, if you want to book a one-on-one with me where we can do a deep dive into any problems, challenges, opportunities that you're seeking, feel free to book a one-on-one with me. Go to my website, www.joeasamoah.com, www.joeasamoah.com. You can schedule one-on-one. where we can do a real deep dive into any situation, any problems that you're encountering, and so on. So let's get that to number 4. How does credit impact the BRRRR strategy? How does credit impact the BRRRR strategy? I'm assuming you know what when I say the BRRRR strategy. It's an acronym for buy, renovate, rent, refinance, repeat. Buy, which is the first B, renovate, rent, refinance, repeat strategy. Okay. And I suppose the question is, why is credit a key factor in executing a successful BRRRR strategy? Why is credit so important if you're trying to implement the BRRRR strategy? Well, the BRRRR strategy relies on refinancing. That's the third R, I think it is. Yes, third R. In order for you to pull equity from your renovated property and allow you to recycle or reinvest that money, okay, into another deal. It's really, really important to be able to take your money out based on the appreciation that you've done in the improvements of the house, and then you can recycle those funds to other deals. So your credit score directly affects your ability to refinance. Okay, a strong score ensures access to competitive loans, including low interest rates, favorable cash out refinance options. Without good credit, you may be forced to take on higher rates, lower loan amounts, or, as I said earlier on, if your credit is real bad, you may not even be able to get a loan in the first place. You'll be rejected. So for BRRRR to work efficiently, timing and affordability is everything. Very, very important. So delays in refinancing can tie up your capital and stall potential portfolio growth. So by improving your credit score, you streamline the refinance process, allowing you the ability to leverage your equity and scale faster. So investors who prioritize their credit can confidently execute the BRRRR method and create a repeating cycle of property acquisitions, renovations, and reinvestments. It's really, really important if you're going to do the BRRRR strategy that you have good credit. So what are some of the action items? Strengthen your credit before refinancing. Okay, ensure your score is optimized before applying for a loan. Work with lenders, partner up with lenders experienced with the BRRRR refinancing, and also monitor equity growth. Track your property values to time your refinance effectively. And number 5, last one before we wrap it up. How can you maintain a strong credit score over time? So what can you do to maintain a credit score, a strong credit score over time? So the question is, what habits and systems can you implement to consistently maintain and protect your credit score? So what can you do, to build your score, to improve it, and maintain it? What can you do? Well, improving your credit score is a significant achievement, but maintaining it is also, especially over the long term, is also what creates longer lasting benefits. So it's good to improve it, but you have to maintain that good score over a long period of time. So the key to sustaining a strong credit score lies in establishing systems and habits that ensure ongoing stability. First thing you want to do is to prioritize consistent on-time payments. Prioritize. It's really important that you make your payments on time for all your financial obligations, such as mortgages, loans, credit cards, and so forth. You just have to make it into a habit to pay your bills, manage your money, don't splurge on stupid stuff, and therefore you have no money to pay the important stuff, especially stuff that's on your credit card, or credit report. So even one late payment can have a lasting negative impact on your score. Even one late payment. So automation and regular payments reminders are really, really important. It's really important to just pay on time. Monitoring your credit regularly is also another critical step. There are monitoring services, credit monitoring services that you can subscribe to, and they'll let you know if your credit score changes, so you can do things and to counter. So monitoring your credit regularly is really important. Yes, there's various monitoring platforms out there. Obviously, you can get your credit reports. There's several free credit report platforms as well, and monitoring services that you can use to keep track of your score, and that helps you flag any changes that may take place. So by staying informed, you can identify errors, potential fraud, or suspicious activity quickly and take corrective action immediately. Okay, you don't want to wait until you apply for a loan, then you realize, oh my gosh, my credit is bad, or this is not true, or this is inaccurate. You want to be monitoring, so that way you can take proactive steps and address these things immediately. Additionally, it limits how often you apply for new credit. I told you about credit inquiries, hard inquiries. Hard inquiries trigger, that's triggered when lenders check your credit report for approvals. And every time you do a hard inquiry, it does lower your credit score. So therefore, avoid unnecessary credit applications unless they serve a clear purpose, such as refinancing for better terms. So another thing you can do is diversifying and managing your credit responsibly, diversifying the type of credit that you have and managing it responsibly. Okay, that's also very important. So maintaining all the credit accounts, even if you no longer use them, just keep them on. Don't cancel them, because it helps preserve your credit history over a period of time, which also affects your credit score. Additionally, using a mix of different credit types, such as credit card, mortgages, and installment loans, they all show the lenders that you can handle different types of financial responsibilities. So by focusing on these long-term habits, you can protect your credit score from denials and position you for continued financial success. So as a real estate investor, maintaining excellent credit gives you both the flexibility to secure financing whenever opportunities arise, and also it's essentially allowing you to scale your business or your portfolio over a period of time. So what are some of the things that you can do in terms of action items, in terms of maintaining a credit score? You can set up alerts, use automated tools to track your credit and detect any changes or errors. Preserve your credit history. Keep all the credit accounts open to maintain your credit history length, and also avoid hard inquiries. Only apply for new credit when necessary to avoid unnecessary hits to your credit score. So that's pretty much it. Let's just wrap it up. Conclusion. So take charge of your credit to unlock better financing options. So I suppose the question is going to be, why is improving and maintaining your credit score essential for achieving long-term real estate success? And wrapping it all up now, your credit score is one of the most valuable tools that you have especially on your real estate investing journey. It determines your ability to secure financing, access better loan types, and also reduces your borrowing costs, all of which have a direct impact on your profitability and your ability to scale as a real estate investor. So investors who prioritize improving and maintaining their credit scores gain access to lower interest rates, higher loan approvals, and greater flexibility in their financing strategies. This competitive advantage allows you, if you got good scores, to confidently pursue opportunities, refinance properties for reinvestment, and achieve sustainable portfolio growth. So by understanding the key components that influence your credit score, such as payment history, credit utilization, and credit mix, you can take targeted steps to strengthen it. There's things that you can do. Don't be passive in this journey. Addressing weaknesses is, like high utilization or missed payments, and implementing healthy financial habits ensures that your credit remains strong over a period of time. So for those employing the BRRRR strategy, the buy, renovate, rent, refinance, repeat strategy, a strong credit is really the key, is the foundation for accessing favorable refinance terms and also reinvesting efficiently. So more importantly, mastering your credit score isn't just about financing, it's about peace of mind. A strong financial foundation gives you the confidence to make smart decisions, weather market changes, and take calculated risk. It positions you for long-term wealth creation and financial independence, and also the ability to enjoy the rewards of your hard work. So if you're ready to take control of your credit, start implementing the strategy that I discussed today. And by improving and maintaining your credit score, you can transform your access to financing, enhance your cash flow, and unlock new opportunities to grow your real estate business. So that, my friends, is it for today. We're going to get to Q&A. So if you got some questions for me, put them in the chat box, and I'll definitely try to get to them in a couple of minutes. If you want to shoot me an email, you can email me at this email address, joe@joeasamoah.com, joe@joeasamoah.com. And also, if you want to book a one-on-one Zoom meeting with me, you can go to my website, www.joeasamoah.com, www.joeasamoah.com. I'll be more than happy to do a one-on-one with you. And finally, for those who want to really step up their game in terms of tenant screening, I do have a tenant screening playbook. Pretty good course, to tell the truth. It's a virtual on-demand course. And as the saying goes, wise landlords don't solve problems, they avoid problems. I.e., you don't want to be having problems all the time. You want to avoid problems. And the biggest problem that a lot of people have is they're just renting to the wrong person. You got the wrong person in your house as a landlord, and so on. So let's get down to Q&A. So what do we have today? And we have Dow2. Hey, Dow2, I hope you're doing well in Phoenix, Arizona. Okay. Good evening from Louisiana. Credit is definitely a big deal in real estate. It sure is. Wealth and wellness with Grace. How you doing, Grace? And hello, please check massage, Fatima. Okay, I'll check my messages, Fatima, and I'll see if I can try to respond. Let's have a look. Hello, I've seen your video. Your content is very good, but as it is not SEO friendly, you are not getting targeted views. So subscriptions are not increasing. Seeing some more issues with your channel recharge. Your videos are not. Okay. Okay. I am waiting for your response. Okay. So Fatima appears to be a social media guru. So let me see what I can do. I'll see if I reach out to you, Fatima. Okay. Good evening, Dr. Joe. If you have great credit, again, if you got some questions, put them in the chat box. I'll definitely try to get to them. Good evening, Dr. Joe. If you have great credit and a small number of real estate transactions under your belt, what are a few things we can do to stand out for hard money lenders? Okay, this is from Aman. If you have a great credit and a small number of real estate transactions under your belt, what are the things that you can do for hard money? Okay, so the question that Aman is asking is that he's got good credit, but he's a new investor. He doesn't do many deals. And so, so from a lending standpoint, he's not as attractive as somebody that's been doing this for a long time. So he wants to know, what can he do? A couple of things you can do, Aman. One of the things is you may want to team up with seasoned investors who have more experience than you, and and then you can show the lender that it's not just you as a new investor, but you have a partner with somebody who's got experience and who's been doing this for a long time. They may have systems, relationships, teams that you can build on or you can leverage on. And therefore, you kind of go in not so much as a one man, but you're part of a network. And hopefully, you're a little more attractive to the lender, the hard money lender. And therefore, you're less, it appears anyway, that you are less riskier, if that makes sense. So also, another thing you may want to do is have what we call a credibility kit. A credibility kit is a document that pretty much shows and explains who you are, what you do, what you've done in the past, and your experience, and why they should borrow you the money. It tells your story, essentially. And that's something that it tries to differentiate you from other investors who, they don't have that. I suppose the important thing is that because you haven't done as many deals, I mean, everyone has to start somewhere. And also it depends on the lender that you go to. Some lenders are more open to, to new investors than others. they may not charge such a higher premium if you haven't done that many deals compared to another lender. So it's definitely worthwhile to shop around and see, compare rates, compare terms, compare different lenders, see what they have to offer. And so, you may not have to pay too much in terms of a premium, especially if you can put together, a team, if you can put together a credibility kit, and if you can demonstrate to the lender that you are low risk, you know what you're doing, you've got the right people in place, and you have the right exit strategy, such that you can take out, or they can, you can replace the hard money either through a refinance or through a sale of your asset, and therefore, the lender can get paid off. Hopefully that helps, Amon. Good evening, Dr. Joe. Happy holidays. This is from Marlon. Hey, Marlon. I hope you're doing well wherever you are. I think you're in the Baltimore market. So hopefully you're doing good. Oh, yes. So today I did a refinance, one of my properties. Oh, it was yesterday, in fact. Sorry. And so, there are lenders out there I've got a pretty good rate as well. Really good terms on a commercial loan. Very, very impressed. I'm not going to say who the lender was, but, if you're interested, if you're trying to do that, let me know. And I can definitely connect you to this lender. They're able to pull together a pretty large loan in a relatively short period of time. It matters about 3 or 4 weeks, and without a lot of drama. It's a commercial loan. What the good thing I liked about it is the fact that it's 30-year, 30-year fixed, as opposed to regular commercial loans, which are 5 to 7 year fixed. And this is amortized over 30 years as opposed to 25 years for most commercial lenders. And, it was relatively straightforward. There wasn't a lot of drama. They just got the job done. And nowadays, that's what really all you want. You want lenders who can get the job done without a whole lot of back and forth, whole lot of drama, and so on. So I feel very, very comfortable now to recommend this company. So if you're interested, if you got some lending needs or refinance needs, then you shoot me an email, joe@joeasimo.com, and I will try to share that with you, and hopefully they'll help you out. I mean, the rate that they gave me was less than I can get anywhere else, and you can't beat them. It was good. Hi, Dr. Joe from DCC. Hi, Dr. Joe from Houston. This is Fred. Must an investor depend on their personal credit score? I assume an investor like you graduates to an LLC standing on its own NOI laurels. Okay, NOI, notice of intent, or is it net operating income? So many different acronyms for NOI. I suppose in this case it's not net operating income. Okay, so let's read the question again. This is from Fred from Houston, Texas. And must an investor depend on their personal credit score? It depends. And many times, if you are buying something in an LLC, well, first of all, there are pros and cons with buying it in your LLC versus buying in your personal name. I've got loans in my personal name. I've got loans in different entities, and so on. There are pros and cons with that. So that's the first thing you have to ask yourself, DCC. The good thing about personal loans or personal residential loans are typically you can get 30-year fixed rate loans. The interest rates are usually lower, and you can get fixed rate financing, 15, 20, 30-year financing. And, you can borrow more. The loan to value is usually higher. That's on the residential loans that you're buying in your name. Stuff like from Freddie Mac, Fannie Mae, and all of these big box, lenders who sell their loans to what we call the secondary market. That's on the residential side. Now, I buy properties, residential properties, but in my LLC. So for those situations, you have to go to what we call a commercial lender. And commercial lenders usually interest rates a little bit higher. They will borrow to you in an entity as opposed to your personal name. The terms are usually 5-year or 7-year fixed rate, and then you have to refinance or reset the loan every 5 to 7 years, and so on. So you pay a premium for going commercial loans, but you can get the loans in your LLC. So if you are buying a property in your LLC, then you're going to go to a commercial lender, and they may borrow you the money, but most of the times they want what we call a guarantor, a loan guarantor, somebody who says, "Look, lenders can say, well, I don't know who this LLC is. It may have just been created yesterday. There's no history to this LLC. So we don't know who this LLC is all about, if it's still going to be around, and and so forth and so on. So with that alone, it seems like a riskier endeavor from their perspective. So what they want to do is to minimize or reduce their risk. And so what they do is they say, well, Joe or DCC, I'll borrow the money to DCC LLC, let's say, for instance. So DCC wants to buy a house in Houston in his LLC. And so he goes to the bank. They say, okay, we'll borrow you the money. However, DCC, we want you to personally guarantee this loan, which means that if your LLC goes out of business, gets bankrupt, or whatever it is, you personally have to stand behind this loan, and we're going to hold you accountable for paying it. So if your LLC goes down to bat or goes, gets belly up, then they're still going to go after you personally for the loan obligations. So, so you got to start somewhere. If you start with LLC, commercial lending, then typically they're going to require a personal guarantee from you. And that's when they're going to sort of may do a credit check to see if, how do you stack up personally? Are you a good risk, or you're a bad risk, and so forth. So yes, you have to a certain extent, be in good standing. Many times they will do a credit check, but also the good thing about commercial loans is that sometimes it's cash based. So it's how much cash is being generated from the asset, as opposed to, sometimes on you. So there are pros and cons, but yes, I had to start from somewhere. I started buying stuff in my personal name, and then over time graduated to buying things commercial, using commercial loans and so forth. No, you can't stand on your laurels. You got to start somewhere. Depending on what your situation is, there may be advantages in just starting. Okay, good question. That's about 7:45. I'm going to kind of wrap it up for the day. I got a couple of things I need to get done. So hopefully today was a good session. We talked about credit, and we talked about different things that you can do to improve your credit score. And we talked about, just wrap it up again, so we talked about what makes up your credit score. And the question we asked was, what factors influence your credit score, and how can you control them? The next thing we did, we talked about was, why does a high credit score save you money? And the question we posed was, how can improving your credit score reduce your borrowing costs and increase profitability? And the third thing we talked about was, what happens if you ignore your credit score? And essentially, what are the risks associated with neglecting your credit score as a real estate investor? And then we talked about number 4, which was, how does credit impact the BRRRR strategy? And the question we asked was, what is a credit? Why is credit a key factor in executing a successful BRRRR strategy? And then number 5, we kind of talked about how can maintaining a strong credit score over time help you, or how can you maintain it? And we talked about what habits and systems can you implement to consistently maintain and protect your credit score. And then finally, we did a sort of a wrap-up conclusion: take charge of your credit to unlock better financing options. And I talked about why is improving and maintaining your credit score essential for achieving long-term real estate success. So that's what we did today. Hopefully it was a good session to you. And let's have a look. you're answering all of my follow-ups. Will you be doing one-on-one consultations through the holidays? What's your hourly rate? Yes, I'll be doing a one-on-one through the holidays. Go to my website, www.joeasimo.com. Let's have a look. This is the DCC. Is this one. Go to my website, which is this one. Book a one-on-one. Go to www.joeasimo.com. www.joeasimo.com. It's $175 for an hour, and it's very reasonable. And all the people that have, we've had a one-on-one have really enjoyed it, and it's really been very, very effective. It's my goal is to, if you're spending $1 with me, is to give you $3 back in return in terms of value. So you're going to gain so much value by doing the one-on-one DCC, and I think you'll enjoy it. I think you'll find it very, very useful. And we can do a deep dive into any of your situation, any of your questions that you have, especially financing. And I'll connect you with some lenders who've got some really good deals, good rates. So I said I've just completed a refinance yesterday, and I'm very, very happy with this lender. And so I would definitely recommend them, and I'll try and connect you if money is an issue and you're trying to raise. So book a one-on-one with me, DCC, and I'll see what I can do for you. Crystal, thank you very much. And thank you. You're such a blessing, DCC. Okay, ladies and gentlemen, I'm going to wrap it up for the day. I'll see you next Wednesday. If I don't speak to you before Christmas, have yourself a wonderful Christmas if you celebrate Christmas. And have a wonderful new year, I think. It's 2024 was a good year. And hopefully your 2025 is going to be even better. So I look forward to seeing you, DCC. And anybody else wants to book a one-on-one with me, please check me out. Let's make 2024 wrap it up to be a great year, and let's make 2025 an even better year. I'm looking forward to 2025. I think it's going to be a great year. Looking forward to it, really. And I'm going to do a lot of travel and go to several countries, and also helping other people on their real estate journey, and also make a difference in a lot of my tenants' lives. So with that said and done, my friends, I will see you next time. Have yourself a wonderful weekend and a week. Thank you. Bye for now.